Hi, everyone. I see we are being joined as we speak we continue to be joined by a few attendees. I propose we still wait for maybe 30 seconds before starting. So hi, everyone. Welcome to our webinar, Politics, Profits, Positioning, organized between IM Global Partner and RBA. I am Jean Monoury, CIO Research and Investment at iMGP, and I am today with Richard Bernstein, founder, CEO, and CIO of RBA, an asset allocation specialist with 15 billion AUM, which he founded in 2008, and with which we partnered in July 2021. With the US presidential election less than a week away, with inflation, GDP, corporate profits, and central banks maybe a little hard to read, Rich will take us through his analysis of the impact of US elections and global politics and markets, RBA's view on global profits, profit cycle using their 30 years experience, how to navigate across fixed income strategies in a low rate environment, and the importance of diversification in today's markets at a time when we believe investors must generally have had a decent year in 2024 in terms of returns, and might have started to be a little complacent with equity benchmarks. He will then answer questions you can ask by clicking on the Q&A button, which is at the bottom of your screen. Before doing so, you heard me talk about partnership between RBA and iMGP. What did I mean by that? Most of you know that we are a worldwide asset management network providing access to high quality investment firms. And we only scout the world for entrepreneurial active asset management firms, which we perceive to be among the best in their respective asset class and investment capacities. We do this implementing an in-depth due diligence approach, which we have crafted over the past 20 years, based on people and on consistency. When we were fortunate to find a firm complementary to our existing partners, which has a replicable and scalable investment approach, with a stable investment team which has proven its ability to withstand adverse market conditions, which has historically offered outstanding track records, we offer to partner and to acquire long-term minority stakes, and this is what we did with RBA in 2021. And we then enhance the distribution capabilities of our partners globally. We help them distribute their products, and sometimes my asset management colleagues launch funds or ETFs with his partners, and they did so as RBA manages now 2 UCITS for iMGP. Maybe a word about why we partnered with RBA. We believe they are unique among their competitors. They have been implementing the same approach for 3 decades now at prior firm at Merrill Lynch. We believe, as you know, that performance is born out of people and that you cannot replace live joint experience. Second thing, that their investment process focuses on fundamentals with emphasis on corporate profits, corporate profit cycles rather than economic cycles. Their approach is centered on corporate profits, liquidity, and investor sentiment valuation, indicators that they have used and refined for 20 plus years. And we believe that their analysis make them far more consistent than trying to assess this economic cycle and macro events. And finally, they can go anywhere, not be everywhere, which we believe allows them to offer an alternative to many of their asset allocation competitors. With this said, I feel very fortunate to have Rich start this webinar by sharing his views and experience on the impact of the coming US elections. Given I believe that they are his 11th since he joined our industry. Rich has over 40 years of experience on Wall Street, and prior to founding RBA as chief investment strategist at Merrill Lynch. Rich, the floor is yours.
Great. Thank you, Jean. Good morning, good afternoon, everybody. I hope everybody is well. I'm going to try and dive right into the question at hand, and that is the presidential election meaningful for the markets? And I think there's two ways to think about this. One is, will there be an immediate market reaction, right? Will the market go up or down based on the immediate results? And I don't know anybody who could tell you exactly what's going to happen in 2 or 3 or 4 days or a week. However, what this next slide shows is that the president really doesn't make as much difference to the markets as people think. This shows you the annualized total return during each presidential term in my career. And you can see that there are 8 presidents in my career, and 7 of the 8 you've gotten double-digit returns. Even during the Carter years where the United States had inflation, that 12% was about a 3% real return out of the equity market. More importantly, if you look on the right side, you will see under President Obama and under President Trump, 2 presidents with starkly different policies and agendas and personalities, completely different people in many different ways. The S&P 500 actually returned the identical amount to the decimal point, 16.3%. That was so extraordinary. I think we checked it about 4 or 5 times to make sure we were right. We couldn't believe that that was true, but of course it is. And it shows you that presidents really don't matter as much as people would think, or as much as the media would lead one to believe. In my career, the losing side of every presidential election, the losing side has always claimed that the economy and the stock market were doomed. Every single time that's happened. But look what's happened. Every single time you've gotten double-digit returns out of the S&P 500. So our story has been that investors should fade the election, not worry about it as much as people think. This is true for industries and sectors as well. We don't have a slide on that, but I will tell you that recently, in 2016, President Trump campaigned really disparaging the technology sector and talking about how we wanted to expand drilling in the United States for oil. During his term, oddly enough, technology turned out to be the best performing sector, and energy was the worst performing sector under President Trump. Then you get President Biden, who comes into office talking about the environment, about ESG, and all these different things. Well, energy has so far been the best performing sector under President Biden. So the pre-election kind of bluster and campaign slogans really don't tell you very much about what's going to happen in terms of industry and sector performance. The other issue that the United States is facing here is about our debt situation in the United States. And this shows you debt to GDP in the United States by presidential term. And this is also interesting. There's a lot of things in this chart that surprise people. Number one, that the biggest increase in debt to GDP was under President Reagan. Most people view President Reagan as one who shrunk government. That's actually not true. He actually increased debt to GDP faster than any other president. Second point, you can see the debt to GDP in the United States hit the 100% mark, which is a terrible mark, right? Nobody should be proud of that. It hit it under President Obama, but then it stayed above that for President Trump and for President Biden, right? A lot of that is the pandemic spending. I get that. But still, nonetheless, that's the case. People in the United States talk a lot about, will the next administration inflate away the debt? In other words, will they allow inflation to go up and solve the debt problems? Because tax revenues are nominal, but debt is fixed. So you can inflate away the problem. They say that as though this is something unique in U.S. history, as though we've never done that before. Well, that's not true. You can see at the beginning of this chart, during Johnson, Nixon, Ford, and Carter, debt to GDP went down. That went down because of inflation spurring nominal GDP. So the United States had a long period of debt to GDP going down because we were inflating away the debt. The other thing that I just want to talk about this quickly on this chart is that people say, well, it's not debt to GDP, it's interest payments to GDP. And how much of the United States cash flow is being sucked up by debt payments? We don't have a chart on that, but I would encourage you to read the report we came out with yesterday, actually. You can go to our website. Our website is rbadvisors.com. And you will find a report that came out yesterday that shows you interest as a percent of GDP. And yes, it is rising quite dramatically, but it was higher, consistently higher for a 17-year period that spanned the Reagan, the Bush, and the Clinton presidencies. So this is not an unprecedented period for the United States in that respect either. So again, this is not a good situation for the United States. Now, some people say, well, isn't there going to be a day of reckoning? Won't the United States have to pay for this lack of fiscal rectitude? And the answer is, there's not a day of reckoning coming. It came. And it came 13 years ago. Okay. So what you see here is the spread between the 10-year US Treasury and the 10-year German Bund. And as I'm sure you know, for many years, both Germany and the United States and many countries in Europe were rated AAA. Well, in 2011, the United States lost its AAA rating. So you can see in the left half of this chart, the Bund and the Treasury trade in kind of a range. At times one yields more than the other. Like as I point out there, German reunification, for those of you who remember that was a period where there was great fears of German inflation and that sort of thing. And so German yields went much higher. But then there was times where the US yield was higher. It just went back and forth until the United States gets downgraded. That's the red line you see in the center. And from that point onward, the United States has sold at about 150 to 200 basis point premium to German bunds in terms of yield, right? Now, you can do this. You may say, well, what's so special about Germany? You can do this with most AAA rated countries, and you will find similar, not exact same, but you'll find similar results, that the United States has higher yields now because it is not AAA rated. Now, everybody knows this, right? That when a bond gets downgraded, the yield spread widens. We know that for corporates. We know that for sovereigns. We know that this happens, but for some reason, people didn't think it was happening with the United States. Why did they think that? Because the absolute rate of interest was so low. Nobody paid attention to the relative rates of interest. But if you think about how every U.S. mortgage, every U.S. corporate bond, municipal bond, every lease, every loan, right, every commercial industrial loan is priced off the 10-year, the United States economy has already been penalized. We've been penalized slowly but surely for 13 years now in terms of our lack of fiscal responsibility, right? What does that mean? It means a greater proportion of cash flow in the entire economy is being siphoned off for debt payments. Those are debt payments that could have been used for productive use, for things like infrastructure, which we'll talk about in a few minutes. So the basic bottom line here is elections are always important. From a civic point of view, of course they're important. From a voting point of view, of course they're important. But from a stock market point of view, they're probably not as important as people think. Okay, does cyclical's performance depend on lower interest rates? Now, we brought this up because our portfolios right now are very cyclically positioned. We are overweight energy, we are overweight industrials, we are overweight materials, we're overweight mid-cap and small-cap stocks, we're overweight emerging markets ex-China, right? We believe that corporate profit cycles around the world are basically starting to accelerate. We know that central banks are cutting rates quite aggressively around the world. This is a good environment for cyclical stocks. In fact, in the United States, we're at a very rare point right now where the Fed is cutting rates as profitability is accelerating. That is very rare in the United States. Normally, the Fed would be raising interest rates into an accelerating profit cycle because profits spur employment. Profits spur CapEx. So normally the Fed raises rates when that happens, but right now they are cutting rates. So that's why we're very cyclically positioned, is we think this is great for the cyclical side of the economy. But do they actually need lower rates to outperform? And so what this little schematic talks about is that whenever you talk about cyclicals, there's always a tug of war that goes on between financial leverage and operating leverage, right? Financial leverage, everybody knows, is how much debt do you have? Are you using leverage to boost your sales and your earnings? The operating leverage, though, is one that people don't often think about, and that occurs more in high fixed cost companies where the marginal unit, the sale of the marginal unit, takes no incremental cost, right? That's commonly called operating leverage. In other words, you have a big fixed capital base producing 10 items or 20 items, there's no incremental cost. That's called operating leverage, and that the sales from that extra 10 units goes immediately down to earnings. So that's called operating earnings. And in every time that interest rates go up, you get this tug of war. You get the tug of war because high capital intensive industries tend to have more financial leverage because they want to finance that capital investment, but they also have greater operating leverage. And so people get concerned. They say, well, rates are going up. That's bad for cyclicals. Well, no, because why are rates going up? Rates are going up because the nominal economy is getting stronger, and the operating leverage is what they always forget. The operating leverage kicks in as they sell more and more units as the nominal economy is growing. History says in this tug of war, the operating leverage wins. This is nothing new. This happens in every cycle that you get this kind of tug of war that goes on, and operating leverage wins. And so what we're seeing here is you're starting to see this in the earnings. This is the earnings of the S&P 500 in the dark blue bar versus the S&P 600, which is the small cap index, in the light blue bar. And you can see that, yeah, large caps are growing and their growth rate is going to go up from 9.9 to 14.7. But look at what's going on here among small caps. We're going from basically minus 50 to plus 50%. That's the operating leverage that we were talking about that puts the pressure on long-term interest rates. So again, the operating leverage usually wins. Here it is for emerging markets. And you can see very similar thing where emerging markets are going from minus 23, 24%, whatever, to plus 27%. Very similar picture. This is why we are overweight small caps. This is why we are overweight emerging markets ex-China, is that this operating leverage is huge in these type of sectors of the global financial markets. Okay, should we worry about an imminent recession or a rapid slowdown? Okay, well, you can probably guess what I'm going to say about this one because we're overweight cyclical, so you probably can guess what we're going to say here. Here is the global profit cycle. This is the ACWI profit cycle. And you can see with our forecast, the red bars at the end, what's happening in the global profit cycle. This is very, very important. Most people are not paying attention to the upturn in corporate profits that's going on around the world. This is not just a US event. This is going on all around the world. And as I said before, profits spur employment, profits spur CapEx. It's very hard, I would argue probably never happened, that you've had an economic recession when the profit cycle was accelerating, right? It doesn't make any sense that that would happen. Okay, so that's the cyclical side of what we've been talking about. Okay, profits are accelerating around the world. Central banks are easing into that accelerating profit cycle. That's very good for cyclical side of the economy. We are overweight energy, materials, industrials, mid and small cap stocks, emerging markets ex-China, trying to take advantage of that cyclicality. But then people say to me, what's the best long-term theme? Excuse me. And everybody seems to think the best long-term investment theme is AI, and we disagree with that. Look, the question is AI going to change the economy? Of course it is. Why wouldn't it? Every major technology changes the economy. The internet changed the economy. The automobile changed the economy. My personal favorite, the light bulb changed the economy. Think about that. We don't even consider that technology anymore. Light bulb was a massive productivity enhancement because you can't have an overnight shift of production in the dark, right? So it was a major productivity enhancer in the economy. So will AI change the economy? Of course it will. But there's nothing special about that. Technology always changes the economy, right? But that's not the issue. We're not here for economic stories. We're here for investment stories. And at RBA, we always think that long-term secular investment stories, you have to think like or pretend you're the one banker in a town with 1,000 borrowers. If you're the one banker in a town with 1,000 borrowers, think about that. You're going to set the interest rate on every single loan. It's going to be wildly profitable. Turn it around. 1,000 banks, one borrower. That borrower is going to make out very, very well, effectively getting free money because the banks will compete away for the only loan in town. The competition will be so huge that the lender will get free money. What does this mean? What am I trying to say? Long-term investment returns are always a function of the supply and demand of capital. And it's really hard to argue right now that AI investments are starved for capital. No. I mean, people are throwing money at the theme. And the more money that they get, even companies have nothing to do with AI are talking about AI because they know that that will attract interest. They know that that will get them a better valuation on their company. That will get them a cheaper cost of capital. Everybody's just throwing money at AI, randomly. Not a good scene. So we think AI is going to be a very interesting economic story, very disappointing investment story. Well, what's an investment story that you can play the one banker in a town with 1,000 borrowers? We think it's all about deglobalization and the reindustrialization of the United States. Now, we think that deglobalization, and look, we think this is kind of staring people in the face, and they haven't thought about the investment opportunities that go along with it, right? Think about what's going on in Eastern Europe. Think about what's going on in the Middle East. Think about what's going on in the U.S. relationship with China. Think about China's relationship with other Asian countries in the South China Sea. Think about what's going on in Africa and Latin America. Globalization is contracting, and we think that's important. We think it's important. Reason number one is because we would argue at RBA, the number one reason that you had secular disinflation, not the only reason, but the number one reason, was because of globalization. What globalization did was just simply open up markets for 30 years and increase competition. And we know that when you increase competition, you get downward pressure on prices. And you see that in this chart. We've taken this chart. This is the U.S. Consumer Price Index. We started arbitrarily with NAFTA, the North America Free Trade Agreement, and we end it with tariffs. And you can see during that time period, the CPI averaged 2.2% a year. So what are we saying people should be talking about now? Well, we think probably 3 to 3.5. Maybe you want to push a little more, 3 to 4 should be your secular theme, but probably more inflation right now than the markets are expecting. Right. And you can see what globalization did to the US CPI right in this chart. Pretty extraordinary. The second reason this is so important is that globalization did exactly what the textbook suggested it should do. And that was production went to where it was most efficient around the world. The problem is that was not in the United States. And so the United States has just continued to run an ever ballooning trade deficit through time as production moved overseas. And you can see that in this chart. So here's the investment theme that goes along with this. Why does everybody understand the national security implications of, say, the United States being dependent on the world for semiconductors, but we don't understand the national security implications of the United States being dependent on the rest of the world for everything, absolutely everything? That's what this chart shows. So this is a story of the United States regaining some element, 1%, 2%, 5%. It's not going to be 100%, but some element of its economic independence. That's all this is about. Very simple. By the way, I will point out this is now a bipartisan issue in the presidential election, since we're talking about presidential elections. This is a bipartisan issue. The Democrats and the Republicans have different routes to solve this problem, but they're going to do it. They're going to do it. And our story simply is we think that the capital markets will be smart enough to reallocate capital to this theme. This kind of, it's not a desire that this is going to, it's a necessity that this happen as long as globalization is going to continue to contract. Oops, sorry. Let me finish up on that. I thought we had one more slide. So we think this is a story of the reindustrialization of the U.S. economy, right? We can talk about things like in the United States, people talk about data centers for AI. They talk about electric vehicles. They talk about all this very sexy stuff. Nobody's thought about, can the infrastructure in the United States actually support all that? The electric grid in the United States cannot support data centers. The electric grid can't support a widespread use of electric vehicles. So here's the way to think about this investment theme, right? Talk to somebody about NVIDIA. Just mention the word NVIDIA and they will see, like, what do you know? Ooh, that's so interesting, right? Great company. Okay, do the same thing, but talk to them about things like ball bearings and carbon wire. And watch them look at you like you have two heads. Like, what are you talking about? Where is the growth in carbon fiber? Well, there's actually huge growth in carbon fiber because that's the way we're going to rebuild the grid here in the United States, right? Energy infrastructure here in the United States is woefully inadequate. I mean, nobody seems to understand that, yes, the United States has shale oil. All U.S. shale oil is for export. The United States cannot use its own shale oil because we do not have refineries that can refine shale oil here in the United States, right? So is the United States a net exporter of energy? Yes, we are. Are we energy independent? No, we're not, right? So you've got energy infrastructure, utility infrastructure, road and rail. I mean, it goes on and on and on. Increasing private sector manufacturing infrastructure. These are the type of things we're looking at. Look, small and mid-cap industrial companies here in the United States that focus on the United States, small and mid-cap industrials, domestically focused, have outperformed the market for a decade. I would question, can you find a theme? Can you find a fund? Can you find a manager that has outperformed the market for 10 years and for 1 year and year to date, and for basically any time period you want to look at, that doesn't own one technology stock? Can you find a theme that doesn't own technology that's outperformed for the last 10 years? I bet you can't. Mid and small cap U.S. industrials have done that. That's the theme that we're championing. It's been going on for 10 years. Nobody knows about it. Nobody cares. A tremendous investment opportunity. So with that, let me sum up real quick. As I said, you can go to our website, rbadvisors.com, and see all these things. You can see the election reports that we put out and everything else. But let me sum up here. Cyclically, around the world, central banks are starting to cut rates or have been cutting rates, and profits are beginning to rev up. That is a very rare and powerful combination for the cyclical side of the economy. We are overweight energy, materials, industrials, mid and small, and emerging markets ex-China. Secularly, is AI going to be a good economic story? Of course it is. Will it be a good investment story? We're not so sure. We think a better investment story is the deglobalization of the U.S. market, of the U.S. economy, the deglobalization and the reindustrialization of the U.S. economy. Again, the U.S. is not going to be the manufacturing powerhouse it was in the 1950s. That's a silly thought. But can the United States gain 2% or 5% or 10% of its manufacturing independence again? That's a huge, huge story that people are not looking at. So, Jean, I will stop there, and we can proceed however you'd like.
Thank you very much, Rich. For everyone, feel free to continue sending questions by clicking on the Q&A button at the bottom of your screen. We already have a few of them, so I'll start by asking them.
Sure.
We can feel from some questions, given the location where we are in Europe. You talked about this new reindustrialization phase. How would Europe benefit from it?
From the reindustrialization, well, certainly certain economies in Europe are obviously industrialized as well. They're very focused toward, like Germany per se, they're very focused towards China. My guess is that changes and that they reorient and focus more towards the United States, more towards other European nations. And, is that good? Is that doable in a short period of time? Of course not. This is a long-term secular story, right? This is a 5, 10, 15, 20-year story. But I think if we were to come back here in 10 years, we're going to find the globalization story will be very different. And manufacturing, the notion of friendshoring, nearshoring, all those kind of themes that people talk about will have taken place.
Thank you. Question about emerging markets. You were exposed to China equities for a long time and decided to sell during the summer. What triggered your decision?
Yes. So remember, we are a very fundamentally based firm. We're not an event-driven macro firm. So as a fundamentally based firm, we follow things like profits, we follow liquidity, we follow sentiment and valuation. And what you saw a while ago, I'll say a year and a half ago or so, was that those factors were beginning to be very positive for China. The fundamental story for China was becoming very positive. The market outperformed for a while, and then it didn't. Despite the fact that fundamentals were getting better, the market underperformed. And so then the fundamentals started to get worse. And so we said, look, if China didn't outperform when the fundamentals were getting better, how are they going to outperform for a sustained period when fundamentals are getting worse? Now, that being said, of course, people see the policy changes that are going on, and people get very excited about China. So we have several backdoor plays, if you will, into China. Emerging markets ex-China obviously will have some relationship with China. Materials, well, obviously some raw materials will have some relationship to China, right? There's several ways that we kind of have this backdoor exposure into China. Energy as well would be another one. So why did we sell China? Because it wasn't outperforming when fundamentals were good. Fundamentals then turned sour, and we couldn't figure out what was the reason to be there relative to other parts of the world where the fundamentals were improving.
Thank you. Maybe a simple question for you, as I believe you are one of the fathers of style investing, having written a book on style investing in 95. Very simple one, growth or value?
So look, I think I've described the financial markets as being like a seesaw right now, where we basically have 7 stocks on one side of that seesaw and everything else in the world on the other side of the seesaw. I would argue the growth universe is very far up here. The growth universe is quite expensive. The rest of the world is in the value universe, and that is the broadest it has ever been. The opportunity set is the broadest it has ever been in my entire career because of this imbalance within the market, 7 stocks versus everything else. We think that presents tremendous opportunity. So my long answer to your question was I would favor value over growth.
Thank you. I see two other questions pending. What is your view on gold?
Gold, interesting. So I don't know how this translates to everybody, but we are not gold bugs. There's people that are called gold bugs, and they want to bury gold coins in their yard because their fear of confiscation and everything else. That is not us. We are not gold bugs. The reality is gold can be a good hedge. It can be a good hedge against volatility. It can be a good hedge against uncertainty, good hedge against inflation. It's basically anything that's kind of bad, it tends to hedge against. And so we usually carry a small amount of gold in our multi-asset portfolios. Right now, I think it's about, because it's been moving, so that's why I'm hesitating here. I'm going to say it's about 3 to 3.5% of our multi-asset portfolios are in gold right now. But I shouldn't say we typically have a little bit of gold in the portfolio just to mute the volatility, right? It's sort of a counterbalance to a lot of things.
You you talked about broadening of earnings. What are your thoughts about the current concentration of the markets and what could trigger a change?
Yeah, so Jean, that's a really important question right now. In the United States, just in the S&P 500, forget the broader US, forget around the world, right? This is just in the S&P 500 itself. In the S&P 500, there are now 70 companies, 70 companies in the S&P 500 forecasted to grow earnings 25% or more. The best part of that is only one of the Magnificent Seven passes that screen. So the reason you're starting to see the markets broaden, admittedly it's slow, but the reason you're starting to see the markets broaden is because fundamentals are broadening and investors are starting to appreciate that broadening was not brief, that it's actually a real event going on. And we think as you see that continuing to grow, you will see as you see the fundamentals continue to broaden, you will see stock market leadership continue to broaden. So again, my seesaw analogy, what causes the seesaw to reverse is just simple fundamentals.
Thank you. And as time flies, I'll pick a last one. What is your view on the US dollar?
So the dollar. So I just want to point out, we do not look at individual currencies. So I don't want to mislead anybody here about any specific currency. The dollar is going to be a function of Fed policy. We know that central banks around the world are cutting interest rates. If the Fed cuts interest rates with them, I think the dollar doesn't really do very much. It's probably not going to be a big story. If the Fed has to reverse course, however, and in 2025 or 2026 has to start raising interest rates, I think we should expect the dollar to be quite strong. That would be my guess. But for right now, I don't think there's a great story about the dollar. The only country, by the way, where currency truly affects corporate fundamentals, only major economy, I should say, where currency truly affects fundamentals is Japan. The Japanese yen is the only country where the currency really is an input to the profit cycle. The yen has a huge impact on Japanese corporate profits, but that's the one place. Most other countries, it doesn't really.
Thank you, Rich, for sharing your experience today. Thank you all for attending this webinar. Please don't hesitate to reach out to your sales representative should you want to receive RBA's insights or learn more about the two UCITS vehicles we are showing on this page. Both of them replicate strategies which have been managed the same way for close to 15 years now. And with this, we wish you a very good day. Thank you very much. Bye-bye.
Great. Thanks, everybody.